Hey guys, and welcome to our third session on trading psychology and mindset mastery. And in this particular module, I want to share with you something which psychologists call the endowment effect. And when you look at this, it's one of the silent assassins that's out there for many a trader. And I've seen this over the years, having worked with so many thousands of people, that once this particular little mine is out there, it can trap you quite often. Let's take a look at what I mean by this. Imagine ourselves coming into a trade, and here's our entry point into the trade. We get into the trade, quite happy about this. In fact, the very next day, the price of the instrument we're trading goes up. And hey, that's a great feeling to have. Everything is going as it should be. And then, a couple of days later, perhaps we see something like this happen. But it's not really a problem because, hey, markets go up and markets go down. Trading does involve risk after all. So we just sit back, and the kind of conversation that you might be having with yourself at this point in time is, hey, let's just wait another day and see what happens. So indeed you do that. You wait another day, and sadly, the trade starts to go against you a little more. Yeah, no big deal. We've done our research. This is a good quality investment. It's bound to come back. You only have to think back of what we've seen in the global financial crisis with the likes of Babcock and Brown or ABC Learning or Macquarie Bank or Rio, just to name a few household stocks, to realize that that whole notion of things can come back can be really quite damaging. Anyway, you're watching it, the next day it goes down a little bit more, you probably weren't expecting or wanting to see that, and then maybe you get a win. A couple of days later it starts to tick up and you think, hey, this is good, I've got my break of trend, we're back on, it's going to start moving up. But it's very short-lived. In fact, at this stage, the price has started to move even further against you. Now, right now, at this price level here, you're probably getting a little bit stressed about this, and perhaps both decision makers weren't involved in this, perhaps you're sleeping on the couch with the dog, but the reality of the situation of what we've got here is that we've started to hold on for too long. We've become emotionally attached to our position here. In fact, you're at this stage here and you think to yourself, well look, I can't afford to realize this loss, I'm just going to hold on, it'll bounce back and everything will be fine. Sadly, a few days later, perhaps we see something like this happen where the price totally collapses. All of a sudden, we're down here and we hit what we call threshold. And that's the point where we go, that's it, I'm done. I've lost all this money on this trade. I'm never, ever going to the market again. You close out of the trade, and just to really rub salt in the wounds, you can almost guarantee that about 3 days later, the price will be back up there just to really screw with your mind. Now, the reality of what we've just seen transpire here, and I'm sure many of you that are watching have had an experience not dissimilar to this. And if you have, I really do applaud you and recognize you for not quitting. This is something that's curable. The problem that we had through here is that we had an emotional attachment to the particular instrument we're trading. And that is what psychologists call the endowment effect. And this is perhaps what we see when we look at it from a trading context. Now, the endowment effect really is that when you own something, when it belongs to you, you value it very differently than you would if you didn't own it. Now, a good example of that would be if you've got an emotional attachment perhaps to an old piece of clothing. Let's say you've got an old footy jersey or some old Oak boots or something like that, and you've had them for years and years and you couldn't possibly part with them because of the emotional attachment that you have to that particular thing. The reality is the item is worthless, it just has an emotional or sentimental value. That's a classic example of the endowment effect. Another would be maybe, I don't know, perhaps if you've ever tried to sell a second-hand car and the valuation that you put on the car is invariably higher than the buyer because it's your car, it's special, you've got an emotional attachment to it. Well, in markets, that endowment effect, that feeling that because you're in the trade or you own that particular investment, it should be worth more, will absolutely kill you. You need to see trades objectively, and so some of the tools and strategies that we use to avoid this pain, this hazard that many, many traders have actually been through, really is on a couple of levels. The first is something we call a stop loss. So every single trade we ever take, we have a level that we put into the market, and if our trade starts to move against us and hit this level, we close out of the trade. In fact, some of the best advice I ever had, I think it was probably my second or third day on the trading floor in London, one of my more senior colleagues came up to me and gave me this advice. He said, look, remember this, all big losses used to be small ones. You just chose to let them get out of control, and the endowment effect will do that to you if you let it. So the key thing here is to always have a stop loss so that it minimizes your risk or loss on the trade. Now, sounds pretty straightforward so far, but when do we set this level for our stop? Well, if you want to avoid any of the emotional baggage, the entry price that you set, the stop loss where you're going to get out should the trade go against you, and also your take profit level. These are the three prices you need on any trade, so this might be the level that you're looking to exit the trade if it works out correctly. When do you establish these three levels? And the answer is before you get into the trade. Don't buy into the position and then wait a couple of days and say, well, we should put a stop in now. You actually make these decisions before you actually get into the trade, and that way you're kind of emotionally detached. You currently don't have any skin in the game, you have no money on that particular trade, and as a consequence you really should be perhaps a little bit more objective in the way that you see it. Now I know that sounds super simple, and so many traders fall over by not doing that. You decide on these levels before you get into the trade, and if you do that, well, you're going to avoid all of this pain, all of this misery that we call the endowment effect. There's just one little thing that's out there lurking in the wings, and that's why building a rock-solid trading mindset, having a unique set of skills that perhaps make you bulletproof in the market, both emotionally and in terms of your ability to discharge your duties, which after all are very simple, to be able to execute your trading plan perfectly every single time. Building up that bulletproof mindset will be critical for your long-term success. If I compare two traders, trader A, trader B, trader A never gets caught up into this noise, this endowment effect, because trader A has a plan, and they also manage their emotions out of the equation by being very, very aware that this hazard could be there. Trader B will get in the market, and they'll get into their position, and they may have a stop that they elect to put in at some point, or they might say to their broker, look, if it gets to that level, why don't you give me a call and we'll discuss what to do next. Now, in my experience, as soon as you get a call to say, what are you going to do next, you're generally going to say, hey, let's wait another day and see what happens. And all you've done is really crystallized more and more loss on your position. It's a classic trap, but the great thing about it is, obviously now you're aware of it, but more importantly, you can fix it in a heartbeat. And most of the typical problems that traders face in the marketplace, provided you've got the right kind of coaching behind you, you can fix in a heartbeat. And this is all about building that foundation. Often when you're learning to trade, the focus is about support and resistance, or indicators, or which instrument to trade, not actually on how to manage this instrument here, which ultimately will be the most responsible part of your trading plan. That will be the thing that discharges your duties, in other words, your mind and your ability to make decisions effectively, but more importantly, it will help you get that consistency and focus in place by having discipline. You build up your confidence in your plan, have the discipline to apply it, and you will be like trader A. Consistent results over time, no stress in what they're doing, no confusion in what they're doing, and most importantly, no emotional attachment to their trading decisions. And that, my friends, are some of the skills that it takes to be successful. And you must have these skills. Why? Because trading is unlike any other business out there. If you think about your typical job, perhaps what you do day in and day out, if you do the right thing, and you're very good at what you do, you might get a pay rise. Better yet, you might get a promotion and a pay rise. In trading, you can do absolutely everything right and still get stopped out of the trade. And to be able to deal with that uncertainty requires a bulletproof psychology. And in these three modules that we've looked at over the last couple of days, I've started to open the door on that for you. There are far more out there, and once you're aware of them, once you've got an idea of what they are, you can make that transition from trader B to trader A consistent, confident, decisive, with no emotion. And that's what being a professional trader is all about. So I hope you've enjoyed the three lessons of the last couple of days. All you need to do now is simply click through and check out where to go next.